Welcome to the Opening Bid Podcast. I'm Yahoo Finance's executive editor, Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor and a better leader. Let's bring in Kate Elhillo, President and CIO of Russell Investments. Good to see you.
Good to see you too.
$333 billion assets under management. That's a large number.
Yep, we're growing.
Does that change how you think about putting money to work? Like every day you wake up like, wow, I got billions of dollars. Like, that's a huge number.
Yeah, I mean, it's a big footprint, but it's across like a global client base and so many different types of clients, everything from pensions to wealth clients. And so we're open architecture. We can invest with some of the best investors in the world. So we've got a lot of room and tools to do that.
I would wake up, it's a burden. Like, yeah. Oh, I got these billions of dollars. What am I doing?
It's weight on your shoulders.
Yes. So my word for this episode is, I guess, froth. Yeah. We've heard a lot of people concerned that there's too much froth in the market. Anytime I hear froth, I view it as valuations have outstripped the fundamental reality for companies, for various lines of business. What say you?
Yeah, I think the fundamental point that you have made is an important one. A lot of the rallies that we're seeing, or a lot of the strength that we're seeing, is for reasons driven by capex. Like people are, companies are investing and changing. Other companies are buying their product, and there is a shift. Whether you want to focus on AI or energy production that we're going to need for all sorts of reasons. Over the coming decades, there's investment that's happening in the markets right now that I think is helping drive the economy, and then you can't get away from the consumer is still quite healthy. And so if you have people spending, here in the US, that's the main driver of the economy, like you can support a market that continues to go up. I think the big thing that is important to look for is, are we going to start to see a sustained broadening in the markets? It still has been
seven
more
stocks,
concentrated.
Kate. Nobody cares about the other 493 in the S&P 500.
Yeah, exactly. And then forget about outside of the US. And so you're starting to see, like with earnings projections and different kind of monikers out there, where there's some expectation that's getting built into the market that with a stronger, maybe a slowing economy here in the US and challenges across the globe, but still stable economy, that you get that broadening, and hopefully, whether it's through tax, deregulation, various things that could happen over the next year, you start to have more companies participating with some of that growth. But that's going to be key for us not to start to get worried that it is getting too frothy and it's not kind of driven by kind of fundamentals.
Do you think the market is frothy at these levels?
I think it's more than fairly valued at these levels, and some of it's backed by expectations that could take a lot longer to play out than what maybe the market is pricing. But it's not like frothy from the sense that it's going up without a good reason to back it.
Mm-hmm. Yeah. I don't want this to sound like me being a goofball, but like I always hear everybody say, "Are we in a bubble?" And I always think that's just a ridiculous question. But I look at the Mag 7, I look at the valuations on these names, 50, 60, 70 times earnings. I look out just a little bit outside the Mag 7, Palantir over 100 times earnings, Tesla 150 times earnings.
Yeah.
Like, does that seem normal to you at all?
No, I mean, it doesn't. And you have to say, like, is the return on investment with some of the really going to play out?
Tesla's going to have to put out all the automakers out of business.
Yeah, exactly. And is there going to be enough happening with self-driving, things like that allow that to get backed up, that price get backed up? It's extreme, right? And so that's where we really focus on making sure we're running diversified portfolios. Like, it's hard to get out of kind of the way of the Mag 7, and being underweight them can still be a challenge, but really diversifying the portfolio is so important because it is getting overvalued in particular pockets.
You talk to a lot of different clients, I imagine, wealth managers, pension funds. Are they still really excited to own the Mag 7?
Generally, no. Like, there'll be targeted holdings that they'll have, and they'll have a strong thesis and case for owning it, but they don't have any issue not owning the other 5. And so that they'll own it, and that's where we'll come into play to make sure that at the total portfolio level we're helping complement maybe some of those underweights, so you're not totally exposed if the market continues to run. But most of the people that we work with, the investors that we work with, they're focused on the fundamentals. They want to have good companies at good price, and the good price piece of it is starting to be a bit of a challenge. And so they're diversifying and they're looking for other opportunities. And that's the great piece of this current market, is that, well, there's going to be dispersion. There's going to be some winners and losers, and we're not sure how the policy stuff is going to play out. And so it's great seeing companies talk about the not Mag 7 and kind of where they're starting to focus, putting their next dollar of capital.
So it's okay to be a stock picker again?
We think so.
Yeah.
We think so. Yeah, and we always, I mean, it's been the last 10 or 15 years where it's always about active versus passive, and passive is just, won the show in so many, cases. And it's hard not to sound like, oh, they're going to try again to say now's the time for active management. But there really does seem to be enough shifts and different kind of trends that are also developing in the market. You're going to start to see, companies having to differentiate, and you're not going to have easy money helping kind of support some companies that might have been able to get through the last 10 years, without kind of getting exposed. So we do think it's going to be important, both at the sector and then particularly at the stock level, to start to really do that hard work.
How hard is it to create a diversified portfolio in this environment? And I bring that up because I see hundreds of companies. They're all exposed to tariffs.
Yeah.
They're all exposed somewhat to, look, a lot of CEOs have told me, I mean, this is chaos what we're seeing out of this administration.
Yeah.
How difficult is it for you to do this?
Yeah, well, I think not just focusing on the public markets, I think, is an important point in saying, am I really truly diversified? So we're going to start at the top of the portfolio and make sure that we're accessing both public and private markets and different types of themes throughout the portfolio. I think there's enough places to go that, whether it's, different countries, certain sectors, where you can have some balance. You stress your portfolio and say, okay, I'm not sure if, the tariffs are going to play out, as we're hearing kind of in the headlines. And even if you just look back a couple of weeks ago, on the weekend, we're worried about Mexico and Canada, and then kind of by midday.
Seems like old news already.
Yeah, it wasn't a problem. And so getting yourself too tied up in those specific stories, I think, is a risk. And just again, focusing on having good companies at good prices and cross sectors, and then stressing the portfolio for different types of policy shifts to make sure you're not overexposed is going to be important. But staying diversified, I think, actually is easier to do. It's honestly it's harder to not get concentrated. That's what I think is the biggest challenge right now, is not to get so wrapped up in a couple of these themes, to get leaning too much into AI or leaning too much into the Mag 7. So staying diversified, I feel it's hard for that reason, because clients are always saying, why am I not owning NVIDIA? Why am I not owning more of, pick the latest. Yeah.
How, when you talk to clients, how concerned are they about tariffs? I think when I hear tariff, it could impact multiple different ways. It could actually impact the sales and profits by a company, but it could also impact the multiple on a company, even if they're not tariff exposed, because the broader market gets more volatile.
Yeah. I think there's a lot of noise that we're all wrapped up in right now, and we're talking about tariffs a lot. And so if last year was all about Mag 7, this year is a lot about policy. Shifts and people being concerned about, okay, am I positioned, right for it? And so you have your spreadsheets that you put together to kind of look at the inputs and penetration costs, and trying to figure out, okay, where is the safe place to be, and you can focus on financials or areas that might not be as impacted directly by the tariffs. But to your point, if it starts to slow down the economy, or if it starts to have impact to the global economy, where Europe starts to really get materially impacted. 40% of U.S. company earnings are driven from Europe, and so while we're pretty insulated, here in the U.S., there still is that connectivity, and then you start to get back and forth in terms of trade wars, and so it can start to get complicated, and it can start to get a bit I'd say confusing, but worrisome if you kind of get too much into the weeds of it. And so I think having a general framework for thinking through how much is it going to impact growth and inflation. Really focusing on is this going to break the economic cycle? Are tariffs going to have a material impact to the cycle, or is it going to be more of a hit, and then we adjust and
do you think it will
on?
Impact the cycle?
No. So our general view right now, and we'll see how things develop, is that it won't break the cycle. It could slow things down. It could slow down growth. It certainly could create a bit of inflation scare and a backup in rates, and that risk, while it's not our base case, is definitely a concern that we're continuing to focus on to make sure as things develop that you don't start to get those, that could be, I would say, detrimental, but materially impactful to the equity markets if you start to see inflation become a concern again.
Is that, if inflation picks up again, is that correction worthy for the markets?
Yeah. Yes. We would say, but partially because the levels that we're at, back to the point of frothiness. So maybe a lot of the run-up that we've seen is largely backed by fundamentals, but there's a lot of things that need to happen in terms of a strong economy for it all to play out. And if you start to say, okay, inflation is going to be more of a concern, rates are going to be higher, that starts to flow through.
Might get a rate hike.
Exactly. I think that does start to get you into correction, whether that's a 10% type of correction or more. I think it'll depend on why it's happening, and the other considerations around it. But it's correction territory.
All right, hang with us, Kate. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Having a really great chat on all things, well, stocks, because that's what we do here on Opening Bid with Kate Elhillo, President and CIO over at Russell Investments. There was a good B of A survey that just hit of fund managers. And outside of all the things that this found, cash levels for fund managers are at the lowest since 2010. So my question is are people just too over allocated to stocks? Do they own too many stocks?
Yeah, it's hard not to be invested in this market.
Right.
Right. And so, again, if you are staying reasonably diversified, it's not a crazy place to be in terms of not sitting on cash. And whether it's yields are at a great level, stocks are it's a reasonable economic kind of profile right now. Being allocated right now, it seems like the prudent thing to do versus being under allocated. Like if you think through soft landing, you've got a pro-business, pro-growth kind of policy bent to a lot of the discussions that we're having here in the U.S. Like being under allocated just feels like it's risky. Leaning into equities more materially, so being levered or being over allocated, that to me is where it starts to get maybe a little bit less well supported. But I could see why if you think there's going to be a broadening out, there's a lot of interesting opportunities in other companies to be investing in. And so you might not want to sell some of your Mag 7, there might be other companies that you're looking to get invested. So I can see why managers are putting money to work, but not willing to necessarily sell down some of the stuff they own.
So within that ideal model portfolio, you have X number of stocks, but how much allocation right now is it to gold? Gold's at record highs.
Yeah.
How much is allocated to alternatives like a crypto?
Yeah. Well, if alternatives is narrowly focused on crypto, so if you talk about gold and crypto, strategically we tend not to have big allocations or any allocations to those type of assets. Within our multi-asset portfolios, we might own some gold. Crypto, we're doing more through some of our hedge fund portfolios or some of our other strategies where we might have some incremental exposure, but nothing direct as of yet. But it is a debate that we're constantly having, and as you start to see both the store of value and the medium of exchange for crypto start to broaden out, potentially you get central banks more involved. It's going to be a discussion we're going to have a more fulsome one around should it be an allocation within the portfolio.
Do you think it really changes the future of what you do and what others in your field do?
I don't think it changes wanting to have a diversified portfolio. To me, crypto is still a speculative investment, and there's a place for it within the portfolio. Yeah, but it's not something I think you start to kind of shift how you think about building portfolios.
You've mentioned themes. So within the AI theme, if you just can't buy any more NVIDIA, where do you go? Yeah,
well, that's a great thing, and this is where public and private markets looking at it together when you're talking about AI is really cool, because you can do the hyperscalers and you can kind of own the big public names that we've all heard about, and then you can start to go into maybe some of the energy companies. And so again, you're all in the public market still. We're having to build out the infrastructure. But when you start to think about the application of AI, and who's really going to change how the consumer accesses AI in the consumer markets, in healthcare. There's so many different ways to be accessing that theme. And so we're spending a lot of time with the different investors that we work with to figure out, let's make sure we're getting a diversified exposure to AI, and maybe even getting beyond, do we need to be the one that's helping fund the infrastructure build out for AI, or would I rather be part of the team of people that's going to help figure out how to actually extract value, because we have AI now as a tool for so many different businesses. And so in the VC community, 27% of deals are AI related, and I think 40% of the capital just in this past year. And so there are lots of different ways to be accessing from public all the way to VC the AI theme.
What do you think about these valuations on these private companies that are touting some form of AI?
Yeah, well, that's we talked about at the beginning a bit that the IPOs are starting, but it really is anything with AI in the name was getting
you could
traction.
be selling puppy food.
Yeah, exactly.
Yeah, but I do it via an AI model on a website. Oh, we're still selling puppy food, guys.
Exactly. So I think that's again, you gotta figure out what am I actually buying.
Yeah, what do these companies do, right?
Yes. Yeah.
Do you think these companies come to market?
I think they're going to come to markets. They're going to see that there's a big tailwind right now, and it's a good time for them to try to do it. And the question is, what price do they get, and how good are the GPs and the end clients at really making the right call as to whether they're ready and whether they're worth that value. That I think is going to be interesting over the next call it 12 to 18 months. Whether we're still so caught up in the theme that we miss out on what is this company I'm actually buying. But I think people are going to come to market.
How how does the average person invest in private markets? I've talked a lot about private markets the past 2 years,
Yeah.
and I always come away thinking like, all right, I have $100. How do I do that now? Obviously more than $100, but like, how do I make that happen?
Yeah, it's gonna get easier and easier in the coming years, and some of this is just new packages that are getting created to, take, in some cases, all private securities, in other cases it's going to be public and private securities mixed together in fund structures that work for the more common investor. And so that's what I think is exciting around private markets. Has gotten a lot more complex in terms of the breadth of places where companies are basically using capital formation in the private markets to drive their growth. It's starting to translate into whether it's like interval funds or tender offer funds or different types of ways that the more average investor can access it. The next couple of years, I do think that is going to start to explode, and the trick is going to be making sure again that you're finding the funds or finding the strategies or the managers that are good at understanding how you create a package that works for the average investor that is maybe a little bit more liquid than the normal private market funds in a safe way. But we're all all different companies right now trying to figure out how to do this. It's going to start happening.
Well, how do you do it? I mean, I feel like I'm listening to you, and it feels like I'm shortchanging myself with my CD. I mean, it just seems so simple. But I mean, to be clear, there's risk investing in private markets, and I always thought private markets are housing, but it's not housing. There's other things going on, clearly.
Yeah. I mean, take credit, as an example. At the end of the day, a company needs, to raise, debt. Like they can do it in the public markets, and you get a bond that's getting syndicated on the desk, or you can do it, in a bilateral way with somebody that is not a non-bank channel. But at the end of the day, it's a loan, right? And so we need to demystify, at some level, kind of what alts are and the types of alts that you can access, and why would I give up some liquidity, or why would I maybe not have quite as much transparency as I feel like I have in the public markets in order to, access this to get a little more income, a little bit more yield. And I think that transparency piece of it is also going to start to get a lot better, in the coming years. And liquidity, I think by design, whether that is going to be through secondary markets being a little bit easier to transact in, for people, or even certain exchanges, starting to be able to access private market investments. The next 5 years, whether it's 2 years or 10 years, as they say, next 5 years, it's going to be easier to both see what these private assets are and then transact with them. Like even if you take like bank loans 15 years ago, for those that were owning high yield debt, bank loans started to show up in people's portfolios, and those are not easy to trade. They're not easy to settle, but you've wanted to get into your portfolio because it was a floating rate instrument. It got you a little bit of extra yield. We figured out how to make it accessible for the common or kind of the broader investor. We're going to start to do that in pieces with private markets.
Is the Federal Reserve a big factor in your thinking? Because it sounds like you're a stock picker. You have a lot of things going on in private markets, and the Fed, sure, if they hike rates, or they, of course, impacts return on investment, but it's not maybe the first thing you think about.
I'd say and sometimes it's the first and the last thing that we think about, it depending on the economics, part of the economic cycle, that we're in. And so, like, is everything a rates trade still? Maybe not quite that extreme, but what's happening at the front end of the curve, how easy money is. You think about smaller cap companies that might have more debt. Like,
so you're thinking like risk-free rate, like really everything you plug into.
It all kind of builds from there. And so it's important, like we said, like a backup in rates, which could be because of monetary policy slip up, or it could be because of fiscal challenges, can have a very different impact on the equity markets, more so than the tariffs that we're talking about. And so, it is a huge part of the discussion we have is what is the Fed doing? It's not the only thing, but it's
In the last couple of minutes of the podcast, we always love to get hot takes from our guests. So let me ask you this one. What is the best investing advice you ever got, and who gave it to you?
I mean, it's going to be around staying diversified, and also knowing what you own. And it was a partner that I worked with during the GFC when I was at Goldman, and there was a lot of running around making sure we understood like what it was that we actually owned and some of the investments.
Which was hard to do during the great financial crisis.
And things that you thought were really safe, ended up being a little bit more challenged. And so really knowing what you own and are you really diversified, I think is like the foundation for how I think about.
You think investors still make that mistake? They think they're diversified, but like if you own the Mag 7, all these companies are correlated to the AI trade, right?
No, I think even just like public markets that have gotten a little bit more concentrated over the last decade, like thinking that if I own the S&P, that's diversified. Like there's so many different investment tools that you could be using beyond that. And so I do think that people go with what they know, they go with what is that they can see and what is maybe accessible. But I do think really getting true diversification, it's a little tougher than it sounds, but it's worth it.
All right, let me try. We got a minute left. So
Yeah.
if I owned NVIDIA, Exxon, and gold, am I diversified?
Theoretically, I guess,
Okay, that's good. I
diversified.
just pulled these things out of thin air.
Yeah,
Like, I'm
theoretically,
just curious, because that's
Yeah.
what a lot of people think they don't have any correlations, but maybe they do.
Yeah, they do.
I don't know. It's fascinating stuff. Kate, it was good to see you. Thank you for all this. Actually, outside of AI, where would you be investing right now if you had other money to work? Industrials, is that?
Well, I think that they're related. I think industrials and some of the cyclicals, as you think about like the broadening from an economic perspective, I think industrials, could be an interesting. And financials have run up, quite a bit, but I think with the deregulation and some of even just like the steepening of the yield curve, there's some interesting things around financials as well.
All right, we'll leave it there for this episode. Kate Elhillo, President and CIO of Russell Investments, 333 billion assets under management, AUM, as the people like to say it on the street. Kate, good to see you as always. Thanks for always coming on Yahoo Finance. We appreciate it.
Thanks so much, Brian.
All right, and that is the latest episode of Opening Bid here at the market site in Times Square at the NASDAQ, where all the action happens. Appreciate y'all always listening. Hit us with those likes all over the podcast platforms and on social media. I love answering your questions, and they are greatly appreciated. We'll talk to you soon.